Good morning. I'm Poppy Behrens, publisher at Modern Storage Media, and I'd like to welcome you to today's webinar. This is one of several educational webinars planned for self-storage owners, operators, developers, investors, managers, and other industry professionals. Before we start, a few housekeeping items. We will have a Q&A session at the end of the webinar, so please feel free to submit your questions through the Q&A button at the bottom of the screen. We will answer as many questions as time permits. Any questions that are unanswered will be addressed privately once the webinar concludes. Today's webinar is being presented by TractIQ. TractIQ is a definitive market intelligence platform for self-storage, tracking more than 70,000 facilities across the United States. By combining verified facility-level occupancy and historical financial performance with owner data, rental comps, and supply and demand analytics, TractIQ sets a new standard for underwriting and deal execution. TractIQ is the official data provider for the Self-Storage Almanac and is trusted by leading investors, operators, and brokers nationwide. Our presenter today will be Noah Starr. And as a side note, Noah will be featured on the cover story of the March edition of Messenger magazine. So if you're not a subscriber, you might want to sign up so you can read it. It's a great story, and I know all of you will love it. Now it is my pleasure to turn the presentation over to our official almanac provider, Noah Starr.
Thank you, Poppy. Everyone settle down. The applause it's kind of a little loud. All right, thank you. Thank you. No, but we're great to be here. Great to be here. It's an honor to be partnered with MSM, and I'm excited to walk through a sneak peek of the almanac right now. We're going to show some data that's I don't think ever been shared before, and the goal of this would be to help investors, brokers, operators, and everyone in the storage industry to make better decisions as we continue to grow in 2026. So with that, I would like to also introduce Ethan Gallowitz, who's our Chief Product Officer, and Taylor Bills, who's our Director of Research. We're going to kind of make this more of a discussion than just me presenting slides, and very much encourage any of you, if you have questions as we go through this, put them in the chat. We'll either, if it's a question that's super timely, we'll probably potentially answer it on the fly, or we can save it for the end. But excited to walk through the almanac, and we'll start right now with one question. How many self-storage properties do we all think exist in the United States? And normally I would ask people to raise their hand, but it's not 50,000 storage facilities. It's not 60,000 self-storage facilities. In 2025, we actually verified over 65,000 active self-storage facilities in the United States. So this is more than Starbucks, McDonald's, right? There's a good amount of storage across the United States. And so this first slide is really just designed to give an industry overview. So I'm going to talk through, here we go. Boom, first slide now has been selected. So you can see some stats here. And again, the structure of this, we're going to walk through some slides. We're going to talk about some data. I'm going to introduce Ethan and Taylor, who have spent more time with this data than anyone on planet Earth. And I think we're going to have some really interesting takeaways. So you'll see a couple of stats here on the right-hand side, 65,000 active facilities across the US, 2.4 billion net rentable square feet of self-storage. And you can see, how much are under development, things like that. Ethan, I'd love you to chime in here in terms of what are the biggest things that stand out to you on this page?
Yeah, when I look at data like this, I really like to look at the trends that jump out. Here, I think the thing that stood out to me is actually that bottom line, which is market penetration, which is basically that's what percent of U.S. households have used storage in the last 12 months. And from about 2005 to 2020, so for 15 years, it was basically stable at 9 to 10%-ish. And then through COVID, it went up to almost 13%. So it increased by like 30%, which 3% doesn't sound like a lot of increase, but that's a 30% increase in demand, which is actually crazy. And so the question is, okay, we've gone through COVID. Going forward, is that going to go back to 10%? Or is it now there's a new need for storage that's going to persist long term and it's going to stay elevated? And obviously, we don't really know the answer to that yet. But a couple of things that I would be looking at. One, I would just look at the leading indicators of storage demand. So I would look at what are migration patterns? Are people building more homes or are they moving more often? Um, and obviously you can look at like remodels and all of that kind of stuff because all of those things are obviously going to drive storage. And one other, I did like a sneak preview talking to the team over at the SSA as well. They won't publish the demand study for another couple of years, but they said in their early polling, um, they think the number is actually going to, at least in the next round, stay up around 12.6-ish. So maybe that indicates that there is just a growing need for storage in the country as well, kind
And
of spurred by COVID.
one thing I want to add in here, and again, we want to keep this spontaneous. So this is kind of a spontaneous thought. But what's interesting, you think of the narrative of self-storage in the last 4 years, you would hear things that are true. Things like interest rates have risen, housing sales are down, storage demand is down. So we've seen rental rates come down, and we're going to walk through all this data, right? But that's like been the prevailing narrative in self-storage. But we have a record market penetration of self-storage in the United States, right? So if we have such a great and a historic high market penetration, why are times so tough? I think that's a question we'll look to answer in the part of this demo, but really interesting macro level data on this first slide.
And I wanna, before you flip to the next slide, I have a question also for the group, or any of the panelists. Feel free to answer too, and you could put your answers in Q&A or however you want. But over the last 11 years, so since 2015, how many times do you think the REITs increased occupancy from one year to the next? So, like maximum occupancy for the REITs increased from, let's say, 2005 to 2006 or 2006 to 2007. Uh, Curious what your thoughts are. I was blown away when I saw the data.
We'll give it 8 seconds. Let's see. We've got anonymous attendee. Thank you, anonymous attendee says 2 times. I think with that, getting some people thinking about occupancy, I'm going to go to the next slide. So bearings, and then I'll let Ethan interject here. What you're looking at here is the REIT versus non-REIT historic occupancy since 2015. And one thing to note, this black line is actually the reported occupancy from Storable. So shout out to Storable, who was a contributor to the Almanac this year. They actually share facility level performance data for more than 25,000 facilities with us so that we can go through it and compare REITs versus the non-REITs. And we're going to compare even achieve rates for storable facilities later on down this show. But just want to lay out the differences here. This gray line in the top is all of the REITs average occupancy since 2015. And then the black line is the storable reported occupancy data since 2020. Ethan, you asked an interesting question. What is the answer?
I mean, I might have anonymous attendee be a presenter because they nailed it. It is only twice. So only in 2020 and 2021 did the occupancy for the REITs increase from one year to the next, which that to me that's mind blowing because kind of like you were saying earlier, we talk about, oh, it's hard times, occupancy is declining. Clearly it is, there's been a huge decline since the peak of COVID, right? Which is what everyone's feeling. But what's interesting is pre-COVID, we were on a very, very consistent year-on-year occupancy decline. Um, that I think when you look at the last 2 years, kind of coming out of COVID, it's declining slightly faster, but like it's kind of on pace with the period before. It's just interesting to see how, because we had that high watermark, it feels very different from how it is when you actually look at the macro data.
Awesome. And Taylor, can you share some context on the storable data that we're talking about here?
Yeah, I'll share a couple of interesting things. I mean, if you look at that REIT line, the tan gray line, you'll notice that average weighted REIT occupancy hasn't dropped below 90% for the last 10 years, which is impressive. And if you're just looking at that data set, I think it would be, if you're underwriting deals, you might be tempted to just assume that you can lease up your facility to 90% occupancy and maintain that. But if we bring in the storable data, it tells kind of a different story. And again, the storable data set is much larger than the REIT data set. Storable, as Noah mentioned, comes from 25,000 plus facilities, which is over a third of total US facilities. Compare that to the REIT data set, which is about 7,000 facilities. So in my opinion, I think storable, the data set there is a better representation of where occupancy actually is for the overall self-storage industry. You'll notice it's fluctuated, between 80 to 90% over the last 5 years. And that's a lot different than what the REIT data is saying. So I think it depends on market to market. If you're a Class A facility in a primary market, the REIT data is probably a good comp for you. If you're looking at deals in secondary or tertiary markets, it's likely that the storable data is going to be a better comp set for you. So it just depends. It's just an interesting story that the data tells when you compare REITs to non-REITs.
Yep. Awesome. And yeah, so what we'll talk about with TractIQ or anything, it is super important to be very intentional. What comps are you talking about? What unit mixes are you talking about? What markets are you talking about? We're going to keep rolling through here. But again, all of this will be in the data, and this is just the first sneak peek. This next slide really just highlights CubeSmart's occupancy. We break down the REIT level occupancy data for all of the REITs in the Almanac and would encourage you all to check that out there. For this, I keep doing the wrong slides. So sorry. I have the power of the slides. Again, this slide here, CubeSmart's occupancy since 2015. We break out all the REITs in the Almanac, so I'd encourage you to check it out here. Let's talk about occupancy data. And we just did on the last slide, but more holistically, Taylor kind of hit it on the head a little bit, where the market, typically, the conversation around occupancy has been across the REITs, right? How does storage perform? Let's look at the REITs. And what's on here, on this slide here, is a time series showing the REIT average occupancies from 2017 to 2025. And I'm going to walk through the data quickly, and then we'll go to my takeaway, because the slide after this is data that's really never been shown before. But just to kind of highlight, if you look at the red line at the top of the chart, this was 2021's occupancy across the REITs on average. You can see pretty much above 95% every single month or every single quarter. If you actually look at the purple line, that's 2025 through Q2. And you can see how, 2025 and 2024 were on the lower end, closer to 92.5%. So really interesting. But again, this has been the conversation around occupancy. What about the other 60,000 facilities or 55,000 facilities across the US that are not part of the REIT data set? And what TractIQ released 2 weeks ago was verified occupancy data for all the facilities in the United States that have CMBS loans. So if we roll to this slide here, again, similar to the storable data set, very different conversation around occupancy. So what we're looking at here would be all of the facilities in the US that have had a CMBS loan since 2022. And you'll see the lines here. All of the lines in green are the REITs that have had CMBS loans. All of the ones in red are facilities that are managed by groups with 15 or more locations. And then the line in blue are all the facilities managed by groups with 14 or less facilities. And you'll notice some pretty stark differences in terms of how REITs are operating, maybe focused more on, physical occupancy versus some others. But Ethan, I'm curious if you have any major takeaways on this slide.
Yeah. So the thing that jumps out to me is that, there's one piece that I think is somewhat surprising, which is that those groups with 15 stores or more compared to the groups with fewer than 15 stores. And you see with the 15 or more groups, so these larger operators but non-REITs, they actually had pretty significantly lower occupancy, lower physical occupancy than those smaller operators. Um, the hypothesis here being, okay, some of these larger groups are really focused on economic occupancy. Maybe they're pushing rates a little bit harder, trying to um, increase their achieved revenue per square foot, that taking that type of approach, whereas some of the smaller operators may have been slower to take some of those tactics. However, there's obviously the counterpoint to that. If the rates are trying to maximize economic occupancy as well, and they're holding a very high occupancy rate here. So there's lots of things that I think you could look into, and we would continue investigating in this. But it's just exciting to be able to start looking at the data broken out by the different bands of operators rather than
Yep.
just seeing the REIT level information.
And a quick question from Robert Moss here. This is across more than 4,000 facilities, totaling $50 billion of asset value. Is this data set that's on the screen right now? And of course, feel free to come talk to us live on a separate meeting. But this is a different data set in terms of occupancy. We're going to keep rolling through here because we can spend hours just talking about each slide. And so really, I'm going to turn it over to Taylor to kind of help people try to understand, like, okay, we're going through a lot of data, right? You're showing me this chart, you're showing me that chart. Which is the ones that are the most definitive and the most representative of the industry? Taylor, would love you to chime in here.
Yeah, I mean, I'm excited for everyone to get their hands on the almanac because there's so much data in there, and this is just a snapshot that gives you kind of a peek into what the portfolios look like for each of the REITs and U-Haul. You'll notice that Extra Space and Public Storage have the largest data sets. I mean, Extra Space has their total net rentable square feet is around 140 million. Public Storage is over 200 million. So it's just important to know what data you're looking at, how big the data set is when you're waiting and doing your analysis. I think another interesting thing here is if you look at Extra Space, CubeSmart, and NSA, nearly their entire portfolio is stabilized same store product. And that's different for Public Storage and U-Haul. There's a much greater number as far as square footage go, and in those portfolios that are under development or in some sort of value add. So Public Storage and U-Haul are doing more development than the other REITs. So it's just interesting to see kind of the different strategies across the REITs and what everyone's doing right now.
Yep. And in terms of the CMBS data that we have, right, you're probably in the 2 to 250 million square feet, give or take, is how big the data set that TractIQ has. But again, storable, I don't know the square footage, but it's 25,000 facilities. So again, that data set is the largest one that we have here. So just trying to help you all contextualize which data sets are the most interesting. All right. We've got some really interesting slides. I think the next couple are going to really be talking about street and web rates. Then we're going to dive into achieve rates. And again, which includes the storable data set, which will be really interesting. Ethan, if you want to quickly talk about this slide, and then we can start with street and web rates since 2018.
Yeah, we won't spend a lot of time on this because it's a blended, pretty high level look, and the other slides go much deeper. But I think the interesting thing here is just obviously there was absolute chaos during COVID, but you can see a very clear seasonality trends pre-COVID for the first 3 or 4 years there. The interesting thing is we now have a full year of actual seasonality. And to me, that suggests we can now start to really pay attention to year-on-year trends starting from last year going forward. Because like I think the COVID stuff, obviously we all hope that doesn't happen again. So we
Or
we
maybe
can't
we
draw
do.
as much of a we
Who
can't draw
knows?
quite as much of a conclusion from anything looking, in that time period, but now is time to start looking at year-on-year trends, which we do in the next few slides.
Yes. Let's go to that. So this next slide, this next slide is kind of just showing, okay, street rates since July 2024. on average, they have been down, right, most of the time. And I think there's a silver lining there. And again, I think the slide after this is more interesting, so we'll focus more there. But Taylor, anything to add for this slide here?
Yeah, I think the one thing I want to say here, as Noah mentioned, I mean, there's been plenty of months where street rates have been negative year over year, but if you look at the tail end of this graph, the magnitude of those decreases are certainly lessening. And what you can see in May and June of 2025, there's actually two months of positive street rate year over year growth. So I think that's good news. I think it's suggesting we're finding kind of some sort of normalcy, some kind of pricing stabilization. And I think my question is like where do we go from here? Are we gonna be kind of in this stagnant, stabilized area for a long time, or are we gonna start seeing some positive trends? I think my opinion is maybe we'll stay stagnant for a little bit, but who knows? At least this data is showing some positive trends. The declines are lessening in magnitude, and there's actually some positive street rate growth trends coming.
One quick thing, a question for Lori and Poppy. How long do we have left on the webinar, just so I can be budgeting time? We have another 30 minutes or so.
I believe we are good. Yes.
Okay, great. Sounds good. All right, this next slide, I think now we can talk in specifics. So I think to Ethan's point, right, there's some general trends you can see from the street rates, but it's not that useful because it's blended, right? So let's look at the actual unit types. And I think we have a really interesting takeaway in some of these slides as to which units have been overbuilt, which units haven't been overbuilt. So if you're looking at this slide here, the chart on the left is showing the street rate growth by non-climate unit types. And on the right, you'll see the street rate growth for climate control unit types. Very different stories, right? We just looked at the overwhelming negative trends in street rates. But if you just look at climate control, right, we actually saw some climate control increases for all the unit sizes except for the 5x5. Versus you look at the non-climate and you'll see a different story. So in terms of your unit mix, in terms of underwriting what a market rent is, right? Need to be intentional with what units you're focused on and even try to understand in a market which units are the most under or overweighted. Ethan, curious on what your takeaways would be for this slide.
I mean, the biggest thing, like I think you can see obviously somewhat of a difference between the non-climate resiliency on the left and the climate resiliency on the right. But the most interesting trend I'm seeing is as you get to larger and larger unit sizes, they seem to be performing much better by when you look at a time series, which suggests that we're increasingly becoming oversupplied on smaller units and undersupplied on larger units. Taylor, I know we were talking about this the other day. You have other thoughts also on why maybe there's a difference there?
Yeah, I'll add one thing. I think if I'm thinking about this from a customer's viewpoint, I think the switching costs are a lot lower for smaller units. If I'm renting a small unit as a customer, it's probably easier for me to find a place in my home or my garage for the stuff in my 5x5 unit. If I'm renting a 10 by 20 or a 10 by 30 unit, I'd probably have to do a lot more planning, a lot more effort, finding a place where I'm going to put this stuff if I'm planning to move out. So that could be a reason why larger units are a little more resilient than smaller units because of the switching costs there for the customer.
Yeah, I think when you're doing your unit mix, and I already see a question from John, would you recommend building or converting the 5x5 to something larger? We're gonna I'm gonna skip to the next slide here in terms of achieve rates. We need to be super intentional with what market we're talking about, what your location is. So I don't, happy to talk with you separately, John, on your specific project. But, the other thing to keep in mind, right? And it goes into one of the reasons why TractIQ exists in the first place is to help people stay away from bad deals. If you're trying to underwrite a market rent that supports the yield of your property, whether it's a development or an existing, if you cram it with 5x5s, your rent is going to be higher on a per square foot basis. And I think there's a lot of reasons why the 5x5 seems to have been the most, you know, seeing the largest declines. And even in the slide we'll go to next, you're going to see something similar. But, all across the board, in terms of unit mixes, we all have to, I think, do the deeper work when we're crafting unit mixes and truly try to understand not just market occupancy for the area in general, but which unit type is actually the most occupied, the least occupied, has the best rates, the weakest rates, promotions, all that kind of stuff. So I'm going to skip 2 slides here because this is really web rate growth. But this next slide, I don't think has been seen anywhere before unless you work for Storable. So it really goes to the question about unit sizes. So what we were just looking at is street rates. And just to level set here, because we're really deep into the data, we define 3 different rates in self-storage. You have your street rate, which is the rental rate that if you were to walk in off the street and get a unit, usually that's crossed out on the website. So the second rate would be the web rate, which is your online rate. And then the third rate would be your achieved rate or your actual in-place rate the customer is paying on average. So what we're looking at here is since 2018, Storable's blended achieved rates for all the unit types. Unfortunately, this is both climate and non-climate in the same chart, but still really, really useful. And, if you look at the conversation about which unit types have struggled the most, Ethan, what jumps out to you here?
Um, well, before I get into that, I wanna also add one more, I think, critical point to think about when you think about like the way that this data is put together is this is achieved rate per occupied square foot. So this also does not factor into account if there is, um, months in between, if there's turnover and there's months in between two tenants. So I want to caveat with that, and I'll tell you why in a second. But to answer your question, the really interesting thing here is the larger unit sizes have been very resilient on their rates, right? They've been basically stable. You look at the yellow line is 10 by 20s, basically flat for the last 6 years, whereas the smaller sizes, 5x5s, 5x10s, have come down a lot. We were just looking the other day at 5x5. Obviously, you get a higher rate per square foot for a 5x5. We're comparing that to the 10 by 20. And in 2018, when this starts, you were getting 4x on average the rate per square foot for a 5x5 compared to a 10 by 20. Now it's actually 2.5x the rate. So it's almost cut in half the premium that you're getting per square foot on 5x5s. What I said at the beginning is you also need to think about how much these units are going to go unoccupied. I don't have the occupancy numbers by unit size, but if I had to guess, these 10 by 20 tenants are staying a lot longer. There's a lot more stuff in the unit. Maybe they're business units as well. They're going to probably have less unoccupied months in between renters versus the 5x5. And so if you factor that in, my guess is that it's actually even a closer spread in the per square foot actual achieved rate, not just looking by occupied square footage, but looking at total square footage that you built, which is in some ways the number that you really care about, right? Because that's the actual revenue that you're getting into your for your site. So the overarching message, like you could take away, is, oh, we need more larger units. As we've said a couple times, it's totally market dependent, and you need to really think about that. But at least this offers a lens and a way to think about it and look at it, that just because there's a higher per square foot opportunity with some of the smaller units does not necessarily mean that you need more of them in your market, which could be a better indicator of what you should do.
Yep. Really interesting. And I think, we've said this before, but I think self-storage has moved into a new phase where we need to be super intentional with the underwriting. We need to go the extra mile. When we're thinking about unit mixes, it's not as simple as saying 10% will be 5x5s, 15% will be this. The unit mix has to really try to fit the market need. And I think by not doing that in the market, you can see now that the 5x5 price per square foot is actually slightly lower than the 5x10's price per square foot in 2024. And you can see how sometimes, I guess in this case, we've been overbuilding the smaller units. So some really interesting stuff here. I'm going to flip to the next slide. It's kind of similar, but again, now what we're looking at is the gray line is Storable's 10 by 10 achieved rate. The red line is street rates for non-REIT managed facilities in TractIQ. Again, it's not apples to apples. We're trying to get as close to as we can because Storable broke out their achieve rates but didn't provide the street. You can see there's some really interesting things here. And you can even see what's really interesting, an 18-month lag, give or take, of when we see the street rate actually showing up in the achieved rate for the storable data set. But Ethan, curious, I think there's some other interesting data points here as to how we think about street versus achieved and achieve rate premiums, things like that. What's jumping out to you here?
Yeah. So I think the biggest thing is there's been a lot of conversation over the last couple of years about REITs basically inverting where their street rate was significantly below achieved rate. And actually, someone just asked a question, I don't anonymous attendee, and I shouldn't have answered it in the thing because it now disappeared. But basically, I think raising this exact point of, you know, REIT actual income was going up over time, whereas the asking rates were dropping over time. And I think what this is really showing, I think pretty loudly, is that may have been true historically for the REITs, that may still be true to a degree for the REITs, but that was not the reality in the non-REIT stores, right? We see there was a 1 or 2 months where the non-REIT operators actually were getting higher achieved than asking rates, but like really that was just a function of people moved in before at these really high street rates, and there was kind of a lag for them to move out. So I think we're very solidly still in what was the historic norm operating environment where achieved rates were somewhat below street rates. And probably one of the ways that you should look at this is web versus street versus achieved, right? How much of a discount are they offering on move-in? What is the actual street rate that they're saying that they're going to get people to? And then most likely the achieved rate is going to fall somewhere in between those two, not well above, as I think a lot of people were talking about because of what was going on with the REITs.
Yep. And you kind of hit on it. And the one thing I would say, and maybe a counter to what you just said, is, well, the street rates don't matter as much, right? The real rate is the web rate, and there's still a big premium that you're seeing for achieve rates versus web rates. However, the goal of this is to bring more transparency, and I think it's really interesting if you think about the larger institutional groups, the conversation is consistently been, you know, achieve rates are much higher than street rates, and that doesn't really show up in the data for the storable data set. All right, rolling to the next slide, and it really kind of is a similar story here as we are really just focused on the achieved rate declines across the unit sizes. And again, this is the storable data set. You can see similar, the 5x5, down 25% in terms of the achieved rates for that unit type. So kind of more of the same. The smaller units have suffered the most compared to the larger units have shown the most resiliency in that data set. All right. This is a different way to look at the same kind of data. I'm kind of going to skip over it just because I think the next couple of slides are interesting. So right now, this one we're looking at is the climate control premium. And again, it's a similar conversation. Smaller unit sizes versus bigger unit sizes. We're trying to look at and understand that data here. This is the climate control premium of street rates versus non-climate. And you can see another similarity. There is barely any premium a 5x5 is getting at the national level for climate versus non-climate. And you think of the cost of how expensive it is to develop a climate control 5x5 versus a non-climate control 5x5. Probably doesn't make much sense to develop 5x5s at the macro level based on this. But Taylor, curious if there's anything that stands out to you here.
Yeah, I mean, I'll just say one thing. I think this chart is basically saying like customers are willing to pay more for a climate controlled unit, and they're willing to pay even more for a larger climate controlled unit versus a larger non-climate controlled unit. And if I'm thinking about it from like a customer's viewpoint, um, I mean, items that likely need climate control protection are larger items like furniture, appliances, mattresses. And if you have multiples of those items, it's going to be hard to rent a smaller climate controlled unit for that. So that, that could be one reason why larger units are commanding such a higher premium is just because the items that people are storing just are larger and they need climate control protection. That's why customers are willing to pay more for that.
I want to say also want to address one of the questions in the chat because it kind of hits on this, which is like the least common unit size, the least common unit to have pricing on is the 10 by 20 climate control, right? Like the larger climate control units, there's just less of them, right? And so when you think about comparing 5x5, you know, premium over a 10 by 20, like on the achieved rate slide, for instance, that we just were looking at, a lot of those 5x5s are going to be climate control, whereas not a lot of those 10x20s are going to be non-climate control. So the actual spread of like for like, if you have a 5x5 non-climate, 10x20 non-climate, or both are climate control, is actually even smaller, most likely, than what the data was showing. So I think just further highlighting, I feel like I sound like a broken record, just some of the asymmetry here in, yeah, people are building like a lot of small units because the underwriting looks good, and if you fill them up, there's a high rate per square foot, but that's not really necessarily what the market's always asking for.
Great. We have a couple of slides left, and then we're going to get to Q&A. So I would encourage everyone, if you have questions, we're obviously deep in the data here. We're saying lots of things that might be shocking, or might be obvious. Who knows? I encourage you to start putting your questions in the Q&A, because we just have a couple slides left. So this slide here really, I think, is summarizing the street and web rate story since 2018. So the blue chart or the blue bars here are showing average street rates. The gray is showing the average web rates, and then the yellow is showing the delta between street and web. And you can see how the discount rate, um, has changed over time. And what's really interesting is the difference in the discount rate shot up to a high right before COVID, probably when everyone thought that the pandemic would be negative for storage, and then it shot back down as the industry realized the demand was overwhelming. But any major takeaways here, Taylor or Ethan, before we open it up to Q&A?
I don't think so. I think, as you mentioned, I mean, we're still kind of elevated on the discount right here, and that might be a trend we see for a while, as we, maybe we're hitting normal territory here as far as pricing goes. So we'll see where the trend goes, but it's been elevated for a couple years now.
Great. And these last two slides, I'll just hit on them quickly. We're looking at rate growth by state. Again, we break all this out in the almanac. This is 20 slides. There are dozens and dozens and dozens of charts and graphs in the almanac, and I think it'll be the best one ever. And again, credit to MSM and Storable and all the folks that contributed to make this almanac possible. I'll just say the states with the highest non-climate rent growth were New Mexico, Nebraska, Louisiana, and Oregon. The bottom states for non-climate growth was West Virginia, Montana, and Arkansas. And then if you flip over to climate control, the top states for climate control rent growth, Louisiana crushed it, positive both directions. That could be really interesting. Minnesota, Delaware, and Illinois. So some really interesting trends. And then we also break this down by the MSA as well. And just highlighting that the top MSAs for non-climate was Portland, San Jose, and Minneapolis. The bottom was, we're based in Austin, Texas, so Houston and Dallas. Texas has a lot of interesting dynamics. But breaking all this out, I see we have some questions coming in, and I think we can start there. So I see an anonymous attendee says, I believe larger units represent a smaller percent of unit mixes, at least on climate facilities, due to developers chasing higher rent per square foot, as Noah mentions, less large units holding higher occupancies, not meeting demand and maintaining a higher rate. I don't know if that was a question, but I think that's a good summary of what we were saying. And again, I think the almanac, we're trying to do as good of a job as we can to summarize the macro level data. But self-storage, honestly, like it is such a hyper local business. It's what is within your 5-10 mile radius, what's in your 10-20 minute drive time, like being super focused about understanding the street versus web, looking at the occupancy and achieve rates of facilities in the nearby area, what new housing is coming into the area. There's so many factors that can, determine the success of a market. So it encourage you, if you're looking at an actual opportunity, the data in here is really useful, I think, for some high level takeaways. But again, knowing your hyperlocal market is super important. Kelly said, apologies if this has been answered already. On average, how many months burn off before web rates match street rates? That's a great question. I think it'll totally depend on the operator, and it'll totally depend on the location. We know operators who have committed to not increasing prices for 12 months, right? So of course the price you move in at for 12 months won't change. Versus if you look at, more some institutional groups or some of the REITs, it could be very different. You can have a 1 month special or a 3 month special, and it'll change quickly. But Taylor, Ethan, not sure if you have anything to add there.
Yeah, I'll add something. If you go back to that slide, Noah, slide 14 with the street versus achieved rates. Yeah, yeah, that one. This isn't a direct answer to your question. I mean, it just depends on how heavily discounted web rates are and a bunch of different factors, but you'll see, I think it's interesting in this chart, achieved rates, the gray tan line there. Roughly, you see an increase in achieved rates about 18 months after an increase in street rates. So that could be a helpful data point, but like Noah said, it really depends on kind of the market and a bunch of different factors.
Great. Another question here. Are lenders looking more at an average between street versus web, or basing the underwriting on web, which could be very detrimental, of course? I'll say a contrarian take here. I think maybe it's not so contrarian anymore. Web versus street rates, I think, are really important. What's more important is understanding the achieved rates in a market. What is the actual historic revenue of that nearby location? I think street rates and web rates, understanding those trends is really important, and we provide as much data as possible on that end. But actually understanding what the revenue that the nearby StoreQuest or the nearby public storage or the nearby facility has done since 2018, how have their expenses changed over time? How has their NOI changed over time? All of that, I think, is really important, and I think has been a data set that the industry hasn't had, which of course we just released. But I think everyone's different, and the problem with the environment on the investment side the last 4 or 5 years is we all just didn't know. We didn't know the difference between web versus street versus achieved. And you can see here, now we have some data on storable. Now we have some data on CMBS facilities. But I think the market was largely guessing. And you can have a lender in Austin, Texas underwrite one way, and you can have a lender in Orlando underwrite a completely different way because there's been such a mismatch between what someone thinks the market rate is. So, hopefully we're in an environment now in 2026 where we have a lot more transparency into the actual operating performance of facilities. And I would encourage you to focus in on there as well. Poppy and Lori, I think you guys have some other questions for us, assuming we have some more time here.
I do. I have some that had come in earlier. Let's see. You showed national occupancy falling 82% in 2025. How much of that decline is demand driven versus supply driven?
So let me go back to the slide that I think you were talking about. All right, I think it was this slide. So, Ethan or Taylor, do you want to take this one? Or I can roll with it.
I can take it.
Okay.
I think the answer is in both. It's supply and demand driven. I think in some markets we've overbuilt. I think in general demand is down across the board. So I think that's a double whammy for self-storage, but really is market dependent. But overall, with mobility being where it is today, I mean, I just read an article this morning. Average homeowner tenure is at like 8.6 years now, which is the highest it's been since 2000 when they started tracking the data. So I think mobility is low, which negatively affects demand for self-storage. And supply is high. I mean, 3, 4, 5 years ago, it was easier to build storage with lower interest rates and things like that. So I think it's a little bit of both. And hopefully we can work out of this
One
eventually.
counterpoint. I was going to say one counterpoint to the whole conversation, because I agree with everything Taylor said. The one counterpoint is this, is that we're at a historic high market penetration in self-storage. Demand has never been higher. There has never been more storage ever than in this moment right now. And that we have the highest market penetration of all time. So I do think the conversation is largely around demand is down and all the things that Taylor, mobility is down. All those things are true. But more people are using self-storage than ever before. So why are times so bad? I think, one of our theses here is the industry's made a lot of mistakes over the last 4 or 5 years. And before TractIQ, I made mistakes too on the investing side. And, I think we've developed in areas we shouldn't have developed. We've overbuilt smaller units, right? So that when we have a historic high of self-storage market penetration, it feels like we're in a recession in self-storage. That is kind of weird to think about. You're at a historic high for demand of storage, yet times are so tough. So, Ethan, I think you were going to add something, but
Yeah, I'm glad you went to this slide because it was actually,
oh,
it was
I'll
on
go
that
back.
same slide that you went to, happenstance. The other maybe thing that's contributing here is just lease up time. So the average size of facilities being built today is significantly larger than it has been historically. So average existing facility size on the slide, it says 37,000. The average size of an underdevelopment site is 48,000. So bigger facilities are being built now, which means that it takes longer, most likely, for them to actually fully lease up. And so that's also going to drag down that occupancy number for a period of time. Just, a larger facility is most likely going to take longer to fill up than a smaller one.
Awesome. I
No,
see a bunch of other questions in here, but Poppy, if there was another one you wanted to.
oh, no. Okay, go ahead. I'll let you tackle those first.
Awesome. So, a lot of questions about.
I see one here. No, let me throw this out. We've
Okay.
talked a lot about occupancy and rental rates and REITs and non-REITs. This morning, I read an article, which probably a lot of people have read now, that New York City has filed a major lawsuit against Extra Space for their deceptive pricing practices. How do you think that's going to impact the industry as a whole? Do you think it will make any effect? I know there's been a lot of talk about the rate structure for a long time, and this has kind of brought it to a head.
I'm going to restate your question a little differently. It's
Thank
going to
you.
get at the same thing. I think Brad asked me, what is the biggest risk for self-storage? Yeah, what is the biggest risk the industry faces? My take, the biggest risk the industry has is if this number, 12.6, drops down to 6 because of deceptive pricing tactics. I think the biggest risk we face is pissing off a majority or a significant portion of self-storage customers. So they say they never want to rent ever again. I'm going to just store my stuff or throw it out, store it with my family or throw it out because I never want to use storage because I had such a bad taste in my mouth. That I think is the biggest risk that the industry has faced. And unfortunately, I don't think anyone on this call is in favor of the government dictating how storage owners should operate their store. However, if the industry doesn't self-govern transparency, it forces the government to do it. And I think when you see things like this in New York or see things in California, right, this is the government responding to people being upset with, deceptive pricing. So, Ethan, I see you have your hand politely raised.
Yeah, no, I'm glad you mentioned the SB 709 in California. I think this is this is just going to keep happening. Like I think it's like you see it in other industries as well. Like at a certain point, people get fed up, and I totally agree with you that it's our responsibility as the storage industry to be transparent with our customers. And I think the way things ended up working out in California, which from what I understand, the initial proposal was a hard cap saying you can't raise prices more than X%. And it ended up in a place which I would argue is actually significantly better, where you just have to disclose what your price increases are going to be, or the maximum price increase up front. I think the question is ultimately, will it stop there or will it go further? And at some point, there is actually the government saying, here is the maximum price increase. And my view is it's all about transparency. If you're, as an operator, communicating, this is what your price increase is going to be, even though you only have to do it in California, that will help protect everyone in the future from more aggressive action.
Yeah, and I'll just add there that we decide, or at least if you own a storage facility, you decide what the price is. And collectively, if you're focused on economic occupancy instead of physical occupancy, there would be no reason to drop your rates, the web rates, to be 40% of what you actually want the rate to be. And if everyone stopped doing that, right, then the prices would more stabilize and you wouldn't have. It's hard to get upset if you say the price is $120 for the next 6 to 12 months, because the customer knows that on the front end versus if it's $50 and 3 months later, now it's $150. That's just a really bad outcome for the customer. And it's going to be hard to make that customer happy, right? Like even if you give them great service, even if you're friendly, your on-site manager greets them with a smile, even if it is the most impenetrable storage facility in the world. No one can ever break into it. Everything's super clean. If you increase my price from $50 to $150, it's just going to be hard to win that person over. So I think we all have a responsibility to talk about this and talk about it honestly. And if the goal is to maximize revenue over the next 10, 20 years in the storage industry, I don't think the way to do that would be to have really aggressive web prices.
And there's a couple of related questions now I'm seeing. One is
We're getting
how to
spicy
combat
here, everyone.
deceptive pricing, and then the other is specifically talking about, if there's REIT practices that are,
One
too
quick thing
aggressive.
here. One quick thing before you say that. We have 5 minutes left.
5 minutes for
I,
questions. So let's, yeah.
yeah, I want
Yeah.
Ethan to answer this question, but I just want to say, in case we run out of time, definitely there's a lot of data. There's so much we're talking about. I would encourage all of you go pre-order the almanac. If you're a TractIQ customer, you actually get a discount to the Almanac. So I don't
We'll
know if
show
it.
that slide in a bit. Absolutely.
Okay, I'll go to it. So really appreciate everyone joining. Now, Ethan, you can tackle
Yes.
that question.
And I promise I won't take the rest of the time on this. I just wanted to say, I think the best thing to do is to be transparent. And I think in saying, I think customers will really appreciate exactly what the California law requires people to do, which is to say, you move in at X, the maximum that we will increase your rate in any given month is Y, or the maximum we will increase it over the next 12 months is Y. And like that doesn't mean you can't increase their rate. It just means you have to be transparent that like you're not going to do it more than you say up front. And that can give them confidence, especially if they have had a bad experience, like Noah mentioned, with others. Um, and I think hopefully this, the laws that are getting introduced in California, maybe something happens in New York, will help force the hand of larger operators to do similar, types of disclosures, and hopefully kind of narrows the gap where everyone is being more transparent across the board.
All right.
Awesome.
Also, you see the slide up here right now for use TractIQ 20 to get a 20% discount on the Almanac. I have actually just reached out to my team, and we will be extending that for you as well if you would like to subscribe to Messenger, because a lot of these topics we're talking about you will find in the monthly publication. We report what's the latest, the greatest, the newest, for better or worse. So use that TractIQ 20 and for either the Almanac or subscription, and you will be all set.
Great. And I know we have 2 minutes left, so I'm going to try to hit on some of these smaller questions because there's like 16 questions that are unanswered. So apologies for not getting to everyone's question, but again, feel free to send us an email or chat with us after. Just a couple of things here is in terms of will you get a recording or copy of the recording? We plan to send out the slides to everyone who is an attendee of this webinar, and I think this recording will also be sent out to everyone, right? Okay, so all of this will be sent out to you. In terms of the market data question, yeah, in TractIQ, you'd be able to see hyper-level market data, whether it's nearby facilities with occupancy data and achieve rate data or street and web rates. All of that is in the same place. The minimum facility size that TractIQ tracks, we track facilities if they're 500 square feet or larger that meet certain self-storage requirements. So, we're in Alaska, Hawaii, trying to track every facility in the country. And the smallest size of facility that I would consider to be investment grade rather than mom and pop, I think it's a loaded question because you can be investment grade even if you're only 30,000 square feet, or 25,000 square feet if you're close to a, hub facility. But generally, the larger institutional groups are probably looking for stuff that are 50,000 square feet or larger in primary or secondary markets, is how I would answer that question. One thing that Kelly said, salutations to Poppy and her staff. She is best in class for the whole industry. Thanks for all that they do and for the industry. I would like to finish off by thanking Poppy, Lori, Brad, the whole MSM team, Travis, for the opportunity to partner with us. It's been awesome putting the Almanac together. We really think it's going to be the best one ever, and super grateful again to Storable and to all the folks that contributed to make this Almanac possible. This was a lot of fun.
Thank you so very much, Noah. And I will just give us a shameless plug here at the end. If you want to know in advance what the 2027 Almanac will look like, you'll want to join us at the show in Atlanta, because Noah and I will be revealing some of what's coming out in that publication at that time. So
My
if you
gosh,
haven't heard about it,
2027 is almost here. Goodness.
that's frightening.
All right.
I
Well,
would
thank
like to
everyone.
thank you.
Yeah,
Yes. Thank you everyone for joining the webinar today. Noah, Taylor, you guys have just been great. Ethan, we are thrilled to have you as our partner for the Almanac, and we're thrilled with the new data that's coming out. And we hope everybody enjoyed the webinar and have a great day.
Thanks,
thanks everyone.
Poppy. Thanks, everyone.
Thank you.
Have a great day, everyone.